This is a podcast brought to you by the Trade Credit and Liquidity Management newsletter. I'm Bob Shultz, and I'm very happy to have Chris Lehnes with us today. We're going to be talking about factoring. We're going to try to unravel some of the cobwebs around understanding what factoring is, how it might be of benefit to your business, and hopefully you'll learn some things that'll be of value. So anyway, Chris, welcome. Um, let's start with some of the basics. Why don't you just give us a description for people who aren't familiar with factoring, of what it is, in terms of its structure and how it works exactly.
Sure. Well, no, thank you once again for having me today, Bob. Factoring in its simplest terms is the sale of a company's accounts receivable in order to raise working capital. It's simply a way for a business to generate cash. Typically, a business that's not able to access funds through traditional sources. So it's not a loan. We're not lending money to companies, but we're literally purchasing an asset from them, that asset being accounts receivable. So a company that's got maybe a lot of challenges, but has one thing going for them, and that is they have good, strong customers and therefore good receivables, is a candidate for this financing. Because you'll find businesses like ours that's willing and interested in converting those receivables into cash. The process for doing that is very straightforward. A company doesn't have to change their way of doing business. They essentially keep doing what they've always done. They deliver their product, they complete their service, they invoice their customer. What changes is now they send a copy of the invoice to the factor. The factor verifies it by contacting the customer, confirming the invoice is valid. And then at that point, they typically advance cash to the company, anywhere from 75 to 90%. So essentially, a business is able to, often on the same day they complete a sale, get access to this cash, which they can then use to do all the things a business needs to do: cover their overhead, pay their employees. Then the factor eventually gets paid by the customer. The customer pays the factor directly. At that point, the factor funds the client that remaining 25 to 10% of the invoice, and then we can do this over and over again. So essentially, that's in its most basic form. It's a way to convert accounts receivable into cash to generate working capital.
So factors aren't reimbursing a company 100%. I mean, they're keeping a piece for their own uh, purpose. I was thinking about this, and it's kind of interesting. Um, Anyone that would shy away from what the factor is making, you need to consider the fact, excuse the pun, that the factor is taking over a lot of your overhead liability. The factor is doing the collections. The factor is interacting with the account. So you have to take that into consideration when you're looking at the fee, that you're saving money. And when you're trying to look at an ROI of, why would I engage with a factor? I think that's a key consideration. I would hope you would agree with that.
Yeah, it's very true. It's not uncommon for us to get objections to the cost of factoring, and it can be anywhere from 1.5 to 3% per month is a typical factoring fee. And when you compare that to what a bank loan might cost, it looks very expensive. But a few points about the one is a point that you've made is that the factor is often taking over some services for you. Some of our clients no longer perform any collection procedures. We do all of that for them. But also, you need to compare what are your options. A lot of our clients can't get a bank line of credit, so comparing us to that cost isn't really relevant. But we like our clients to focus on the margins. Okay, if our financing allows you to complete more sales, now maybe you're doing so at a slightly lower margin. The difference being the cost to the factor. But if it's incremental sales, you're still dropping of a large percentage of that margin to your bottom line. You're able to bring on new customers, grow your business, and get to a point where maybe you become more bankable, more sought after by the more traditional lenders. But it's very true that if you're going to be talking to small businesses about factoring, you need to recognize that the subject of cost is going to come up.
Yeah. So is it necessary for a company to turn over their entire accounts receivable file, or are there options that where they can pick and choose? What are the realities there?
Well, it really depends upon which factor you work with. There are some factoring companies that do require you factor all of your invoices with them. It's kind of an all or nothing scenario. There are others, such as Versant Funding, where we do not require that. We have many of our clients factor all of their invoices. Some are factoring some subset of their invoices, and we have others that are factoring just a single customer. And for us, any of those things are okay with us. So if you're a business considering factoring, you need to determine what works for you. Are you willing to factor your invoices, or are you looking for a source that's a little more selective? And if so, that's a question you should raise early in your discussions with a potential factor.
Yeah, and another thing that comes up is what's the difference? You could describe the difference between a recourse and a non-recourse factoring arrangement.
It's a real key difference, and something else a lot of clients overlook and don't really spend any time talking about, is with a recourse factor, usually after some period of time, often 60 days, sometimes 90 days, after a period of time, if an invoice hasn't paid, that factoring company just puts it right back on the client. They basically take the money back that they had advanced because they have recourse against their client for non-payment. At Versant and at a non-recourse factor, they are taking on the credit risk. We are taking on the credit risk. So whether or not the customer pays is we are taking that credit risk. Now, that being said, one thing the client always remains responsible for is performance. So, for example, we buy an invoice and that underlying customer goes out of business, well, that's on us. Shame on us. We lose. If the customer doesn't pay because the product was defective or the boxes were empty, they were never delivered, that remains the client's responsibility. So, with a non-recourse factor, the factor taking on all credit risk on those invoices. But with a recourse factor, they're not taking on any of that credit risk and can put back an invoice to the customer for non-payment.
Is there a difference in the in the amount that will be funded by a factor based on those two variables?
So there's a couple of differences with a recourse and non-recourse. For one, the underwriting process is often different because at a non-recourse factor, all we're focused on is the underlying customer, the receivable. So we don't care about the quality or the performance of our client at all. But with a non-recourse factor, it's often more of a hybrid analysis because there may be points where you need your client to pay you back. So there's a little more in the underwriting focus on the performance of the company. So for one, that will lengthen the approval process time and also might shrink your chances of getting approved because there is that added layer of underwriting. But also because of the different approach, a non-recourse factor might be more costly than a recourse factor. The recourse factor is taking on less risk, and so they can often charge less than a non-recourse factor would charge.
Yeah, it's
The
really
advance rate sometimes also I'm sorry, I didn't mean to interrupt, but the advance rate also, how much money you get up front might be higher with a recourse factor than a non-recourse factor because, again, they can just take the money back if the invoice fails to pay in a period of time.
yeah, got it. Just let's dive just one level deeper into the fee. It's 1.5, 2.5%. Uh, can you just draw out a scenario that explains how that's calculated, and what the variables are there in terms of what the ultimate fee is?
Sure. In terms of what fee will be assigned to any one account, depends upon a few criteria. One is, as I alluded to, a recourse versus a non-recourse factor. The fee is likely to be higher with the non-recourse factor because of the added risks that they're taking. Another key component in how much you can expect to pay is really how much you will factor. A smaller company factoring a smaller volume of invoices is more likely to pay a higher rate than a larger account where, just because of the efficiencies that come with a larger account. But then in terms of how much fee you can expect on any one invoice, it's really all about time, how long it takes an invoice to pay. In most cases, the invoice or the fee starts accruing on the invoice date, the date the invoice is issued. And then it continues to accrue until payment is received. Now, how the fee is calculated can vary from lender to lender or factor to factor. What we do at Versant is there's a 30-day rate and then a 10-day rate. So it goes up in 10-day chunks after the initial 30 days. So not to get too deep in the weeds, but if the rate were 3% for 30 days, it would be 1% each additional 10 days until the invoice pays. Some factoring companies might charge a factoring fee and an interest rate. So you'll pay a fee on the invoice but then just a regular old interest rate on the money advanced, and then you got to kind of figure out how much it actually costs you. So it's important that you talk to your factor and understand how they're calculating the fee because it can vary. But ultimately, like most forms of financing, the longer the money is outstanding, the more you can expect to pay on it.
Yeah, well, it's interesting. It really begs for a lot of due diligence if you're a creditor to really understand what you're signing up for and what the true value of it is.
Exactly.
Liquidity is such an issue these days with companies that that the cost versus access to cash to keep the lights on and hopefully grow your business is a
Mhm.
pretty compelling need. Chris, you've been doing this. You're a real expert in this area, and again, I appreciate your sitting down today. Um, Based on your 15 years of experience in this industry, what kind of companies are most prone to benefit from factoring?
Well, most generally, it needs to be some type of B2B or B2G business. So some business that's selling their product or service to other large entities, so large commercial enterprises or government agencies. So that's a key component. They tend to fall into the categories of manufacturers, distributors, wholesalers, a wide range of service companies, staffing companies, software companies, consulting firms, a wide range. But what they all have in common is they have strong customers. Now, the sort of the next level from that is they have a funding need that's they're not able to meet through traditional channels. So typical clients of factoring, maybe they qualify for bank financing, but it might not be to the extent that they require. They can't get the large enough financing package from a lender, or their funding need is too imminent. They can't wait to get through the process of a traditional lender. So they have a fast or an imminent funding need that can only be met through a quick source of funding like factoring. Some of our clients, their need is just very short term. There's just a bridge. We're bridging them to an equity raise. We're bridging them to a sale. I'll just mention that some of our clients, an increasing number, I might say, are private equity owned. So they've got capital behind them, but that private equity sponsor is maybe just not willing to put more cash into this business, or they feel it could do better elsewhere. So through our quick contribution of cash, we can help get a company ready for that next stage, which might be another equity raise bringing in more partners, or might be a sale. But that's a lot of words to say all of our clients have strong customers and have a funding need that can't be met through traditional sources.
In my experience, both as a functional person in the credit collection space and also as a consultant, I've introduced factors and outsource opportunities to my companies and clients. And there's always the pushback of, whoa, wait a minute, they're going to talk directly to my customers.
Mhm.
Why don't you explain how that works and put people's mind at peace a little bit on concerns they may have of having a third party interact directly with their customers.
Yeah, but that's a very common concern our clients have, particularly at the beginning and when they're inexperienced in the world of factoring. And it makes sense. You should worry what your customers think about you. But the reality is the fact that you're factoring your invoices is going to have no impact on your customer relationship, no negative impact on your customer relationships. For one, as I mentioned, our typical client or the typical factoring client has nice, big, strong customers. Those big, strong customers you can guarantee are paying thousands of their suppliers through this type of channel, through factoring. So, for example, companies like Amazon and Walmart and Target, we're not even interacting with a human. We're accessing a portal, we're clicking some fields, and now payments are being redirected. So a company like that isn't even going to know that you're going to factor. They're so comfortable with it, they're so experienced in doing it that you're never even going to notice. But then there's sort of another category of business that our clients have as customers. It might be more of a mid-sized business. They too are paying a large percentage of their suppliers in this manner. So it's just not the red flag our clients worry it's going to be. We talk them through it. In many cases, we will introduce them to other clients of ours who came to us with the exact same reservations. But the reality is factoring is much more common than a lot of small business owners realize. It's their customers are doing it for other suppliers of theirs, and it's just not going to sort of set off red flags or really be any cause of concern. Now, in some cases, we encourage our clients to tell their customer they're doing this, to be very upfront about it with their business contacts, because this is good news. This is I've got more cash now. I can better serve you as a supplier. So even though we're mostly dealing with the accounts payable department of their customers, and the business people might not even know this is happening, in some cases we encourage our clients, tell them what you're doing so they'll know you're going to be more liquid and better able to serve them going forward.
Yeah, that might also work with their own suppliers who are looking at them as a credit risk, knowing that they have
Mhm.
better liquidity. You mentioned earlier that you verify that an account is real. Can you explain what does that process involve?
Sure. It's highly customized depending upon who the end customer is. So I mentioned earlier, huge companies like Walmart and Target, all we're doing is logging into a literal portal website that just to see the status of the invoice, know that it's approved for payment, and at that point, advancing cash to our client. In other cases, we might be sending an email to an accounts payable person to verify an invoice, saying, here's the payment, the invoice details we have. Is this accurate? And as we get lower down the sophistication level, we might actually have to pick up the phone and call somebody in an AP department to verify terms. But we do whatever makes the most sense for that customer. And all we're doing is verifying that the terms are valid and that the invoice is approved. And again, these accounts payable departments, this is one of the things they're doing all day long. So our request isn't confusing or worrisome. It's so routine and something we do. And I should also mention most factors, while at the beginning you're probably fact checking every invoice to make sure everything is valid. Over time, as you get more comfortable with an account and you know how invoices pay and the process, you might do more of a spot check, or maybe you're not verifying every invoice immediately prior to payment. But sort of as you start, you want to be very careful up front to prevent fraud and understand your client's relationship with their customers. But over time, it might be a little less rigid in terms of the percentage that you verify and the timing of those verifications.
So those queries to validate that an invoice is real goes on your stationery or from your email address. Are there eyebrows raised ever? I mean, you said it's a fairly common practice. So what type of pushback could a company considering this expect?
Well, the first thing we do that I didn't really talk about is when we first set this up, we're going to have our client send a letter to their customers on their letterhead indicating what's going on. We're entering into a funding relationship with our factor to help fund our growth, and going forward, payment should go to this address, this account, and our information. So there's an introduction that happens from our client to their customers. In some cases, if it's a very important account, we might do a joint call saying, here's Versant, they're going to be working with me going forward. So the introduction happens before we're making that first call or outreach to verify an invoice, so they know who we are and what we're doing.
Does a company change the remittance advice on their own invoices then?
They do. They do.
Okay, got it. All right. Um, well, this has been really interesting. Based on your experience, I mean, you've been in this world for a long time,
Mm.
and you're looking at receivables and you're approving and you're actually funding them. What tips can you give somebody managing an accounts receivable portfolio that would make it easier to obtain this type of lending? Any advice you can give someone?
Well, I can tell you some of the things we see in terms of how companies manage their accounts receivable, and we see a lot of them just don't. They just kind of invoice and then wait to get paid and see what happens. We would encourage our clients to pay attention, monitor the receivables, keep track of things like concentration. Are you getting a lot of outstanding with any one customer? Maybe do some credit checks up front. It's often surprising to me how many businesses are afraid to say no to a sale. It's like, particularly when they're young and they're hungry and they're growing. Somebody wants to buy my stuff, I'm going to sell them my stuff. Well, you got to make sure that customer can pay for your stuff. So do some verification, some investigation up front on how much your customer could really afford to have outstanding. Because there's been more than one time in my career where the reason they're talking to us is because they got stiffed by a customer. So be careful who you're extending credit to. Be mindful of how much you have outstanding to your customers. Monitor. I can tell you with almost without exception, receivables pay better with us than they did with the customer. And the primary reason for that is we're monitoring this stuff. We're watching it. So when an invoice goes beyond terms, we're checking in. And sometimes it's as simple as, oh, we never got that invoice, or oh, we need the PO to go with an invoice to pay. It's some just stall tactic that they're taking to slow down payment that we're on top of. That sometimes a business that's, they're looking in every direction. They've got a lot of things to worry about in running a business. We've got one thing to worry about, and that's just the receivables. So doing some of the things that we do, like it's just paying attention, monitoring the performance, monitoring exposures, can do one or to improve the performance of a portfolio for any small business.
If most companies have some form of bank facility, how does this interact with, banks have blanket security liens on all assets, including receivables. What bumps in the road are there relative to that?
Yeah, that can be tricky. And the answer is it kind of depends upon what type of financing we have in place. After the pandemic, such a high percentage of small businesses have some type of SBA disaster recovery loan, an EIDL loan is often called. Those are we found very easy to subordinate. So we can move an SBA loan like that out of the way. They're very cooperative and subordinating. Outside of that, it's hit or miss. A traditional SBA loan depends upon your relationship with your lender and how you've been paying and their willingness to subordinate, because you make a good point that ultimately we're going to need to get a first lien against the accounts receivable. Doesn't need to be against all the other assets, but we do need it on the accounts receivable. So depending upon what type of financing is in place and the client's relationship with the lender is really going to determine how much we can help. We also see all over the place MCAs, merchant cash advances, that companies take, and they almost always file a blanket lien, and they're not very helpful and cooperative. So often, our only means of getting our facility in place is by paying them off, which sometimes we'll need to do. We're going to kind of be our financing will be part of a debt restructuring for the client, and that we're cleaning up some of these smaller balances that are outstanding from MCAs. But it's kind of a long-winded way of saying it depends. And it's always one of the first questions we ask a prospective client is, what financing do you have in place? And depending upon what it is going to determine what do we do next. Now, I have a colleague in the world of factoring that will fund in second position behind behind an SBA lender, but that's rare and it's very limited in how much funding you can get. So for the most part in the world of factoring, a first lien is almost always going to be required against those receivables. And if you've got other financing, some negotiation might get you part of the way, but sometimes those lenders just aren't going to budge, and you'll have to need to pay them off or postpone factoring until those debts are paid down.
So to paraphrase an old saying, if there's a will, there may be a way. Got it.
Maybe, not always,
Okay,
unfortunately.
you're with Versant Funding. Just in closing, why don't you tell us about Versant Funding a little bit and how you're distinguished from other factors? And I think that'd be interesting for people to
Yeah,
hear.
Versant is a little unique in the world of factoring. I've been doing this for a while with a few different sources. I worked for Versant for a while, about 10 years ago, and they came back to them about 5 years ago. So they are different in a couple ways. One is our true approach to non-recourse factoring. We literally ignore all other aspects of the company. We're not looking at financials. We're not looking at tax returns. I don't ask for a personal financial statement. I don't run a personal credit check. None of that matters to us. So that allows us to move very quickly because that's not part of the underwriting. And also it means that businesses that have those shortcomings aren't kept out of the of our portfolio. So companies with big losses, big deficit net worth, owners with very poor credit, and honestly, even say some character issues we've gotten past in the past. Is owners that have had some trouble with the law, which is going to knock you out of most banks. We've been able to work with and help them rehabilitate their reputation and eventually move on to other financing. So our non-recourse approach, I think, is unique in our true dedication to non-recourse, and the fact that we're privately funded. Most factors have some lender or other factoring company behind them, which puts in restrictions. There are covenants that go along with that funding that might preclude things like customer concentration or the age of the receivables they factor. Those don't apply to Versant. So we've done a number of deals with 100% customer concentration, one customer we're factoring. And that makes us unique. Not many will do that. And the other that's unique is our willingness to factor older invoices. Most factors won't look at anything sometimes beyond 6 days, but certainly not beyond 90. And we've had many cases where receivables are going 120 days. But because of our approach in that we got one guy, our owner, Mark Weinberg. If he's in on the deal, we do the deal. We don't have to ask anybody for permission. So that allows us to do some things that are out of the traditional box and also to move quickly because we don't need anybody's permission. So I think those are what make us a little unique in the world of
That's
factoring.
outstanding. Hey, Chris, thank you so much. This has been extremely informative. A lot of
Thank you,
facts
Bob.
jammed into a fairly short
I can
period.
squeeze a lot in there.
I would advise anybody if you've got questions about factoring or you want to pursue information about Versant to contact Chris. His contact information will be included when we publish this. So this concludes another podcast brought to you by the Trade Credit and Liquidity Management newsletter. You can find us at tradecredit.substack.com. I would encourage you to take a look and hopefully subscribe. And with that, Chris, signing off. Thank you again.
Thank you so much, Bob. I appreciate it.